Um, I want to talk about what makes somebody a good stock picker. And number and I would say stay away from finance mania. You know, like I said, most hedge funds they get you 7%, if that. Usually it's less than that because what happens is when the stock market is up, people buy, and when it is low, people sell. So they buy at the wrong time and they sell at the wrong time. And they might get a 2% return just because they were idiots and they bought at the high and they sold at the low. Um, Whereas if you just invest in the S&P 500, not now, but in throughout the last 40 or 50 years, you got a 10% return. You don't need a financial expert or anybody to tell you just to buy the index. Now, the reason for me being here is I believe I can get a 20%, a 50%. Not every year. The best stock pickers, let's say there's 10 years, a 10-year time frame. I mean, you might be at the lowest decile. You might be at the lowest decile 4 years out of 5. And the reason the average hedge fund does terrible is because to keep their job, basically they just want to be average. They want to be like everybody else. So if everybody else is buying Tesla, guess what? They're buying Tesla. And even though Tesla, might go down 500%, it's the average because everyone else is doing the same thing. So it's all job security. If you don't do too much outside what everyone else is doing, you're going to keep your job. And I think that's terrible. I mean, you look at Warren Buffett. Does he live in New York? No, he lives in Omaha, Nebraska. Well, I don't even know what they got there, but it's probably like cornfields and it's basically as far away from New York as you can get. But you can read, you can read financial reports, annual reports, quarterly reports, use your stock screeners. Um, I think what makes a good investor is staying as far away. Um, yeah, I mean, I'll watch Bloomberg from every now and then. I'll watch Fox and the Fox Business or MSNBC or whatever it might be. Um, but you have to be careful because a lot of times they're telling you to buy something at the same time they're actually selling it. Because most people, most of the hedge funds think that the average investor is a stupid idiot, and most of them will bet do the exact opposite of what you're doing. So if you're buying Tesla, they're selling it. You know, um, if you're selling Microsoft, they're buying it. They do the exact opposite of what you do because they think you're a dumb idiot. And like I said, the average retail investor has a huge advantage over the traditional hedge funds because you're playing with a lot smaller amounts of money. Um, I can invest in the companies that are 30 million, 50 million, 100 million. If you're managing 200 billion dollars, you can't even buy. I mean, unless you plan on buying like 15 or 20 entire businesses, you can't mess with that universe. So their universe that they can invest in is very small, and whereas the universe that we can invest in is very large. Um, and by investing in stocks that are say below $10, that are low market cap, that are ugly, that are hated, that are boring, this gives us a huge advantage over the quote quote smart money. The banks, the hedge funds. Um, but that smart money wasn't too smart when half the banks in this country almost went bankrupt a couple months ago because they were underwater in real estate and they were underwater um, in the bonds. The place we're at now is uncharted territory, and if you are a value investor, you love volatility. And volatility does not mean more risk. That's just not true. I mean, let's say my analogy of gold, and you might disagree with me, but dating from the time of Christ till now, gold on average has been around $1,300 an ounce. I mean, of course, the government set a price at one time or whatever, which manipulated the market. But the true value, in my opinion, has been $1,300 an ounce. So if the price is 2,000, which it is today or higher, it's expensive. But a couple years ago, when it was 1,000 an ounce, it was cheap. So the game is very easy to play if you know what the value is. let's say I think the value of Apple today is 4 trillion. So if it's selling for 2, well, down here it's cheap, or I should say very cheap. And then if it gets to 3, maybe it's like fair value. If it gets way up here at 5, it's expensive. I'm not saying Apple's worth 2 trillion. I don't own any Apple personally. I guess I will when I buy Berkshire Hathaway. Berkshire Hathaway owns about 6% of Apple. So by owning Berkshire Hathaway, you basically get exposed to Apple by default. And if you own the S&P 500, basically 20% or more of the S&P 500 is basically the top 10 companies in America, probably more than that. So that's a risk by buying the S&P 500. Is cap weighted, and unless you're buying the ETF that is non-cap weighted, that you're paying a premium for. But if you know the value of something, it's a very easy game. So you basically just have to learn how to value businesses, and and grow your competence. Like, I don't know, maybe all you know how to do is utility stocks, and then you I don't know, go into manufacturing, and then I don't know, EV stuff, electric vehicles or something. I don't know, but basically you got to grow your competence in whatever you're and make you an expert. So you're the expert, in these fields. And if you look at these large hedge funds, they will have people specialized in one particular sector or whatever of the economy. Like I said, I was invested in a lot of gold miners a couple years ago when I thought gold was very cheap. When everybody loved EV and hated oil, I loved oil, because you got to find out where the craziness is today. You got to stay away from the glamour stocks. Like Tesla. Because and go into the boring. Like trash pickup, sewage, Things like this are boring and not popular. It's not sexy. It's not glamorous. But what this is money. And yeah, it's possible that some idiot buys Tesla at 3,000, and then another idiot buys Tesla at 6,000, and then another idiot buys it at 10,000. But it doesn't mean the company is worth 10,000 a share. That just means some idiot paid more for it. But if this garbage company is worth $5 and it's selling for $1, there's almost no way you can lose money unless the company goes bankrupt. But even then, the company is selling at such a low discount to what their net assets are that you're still not going to lose money even if the company goes bankrupt. But yet 90% of people, they go for this. They go for the lottery ticket. They go for the glamour. And they don't like the slow and steady. They don't want to wait 20 years to get rich and have $5 million or $6 million after 20 or 30 years of investing, slow and steady. They want that one home run, that one grand slam. And so if all the money is going into Dogecoin, Bitcoin, Tesla, etc., all this money is going into the dream. They're all going into the lottery tickets. They're all going into the glamour, which means there's no money to go into the boring stuff, the ugly, the hated, the ones you got to pinch your nose and hit the buy button and look the other way. Those are the value stocks. Those are the ones you're going to make money on. You're not going to make money on these, you might make money, but it's a gamble. You might think another idiot's going to pay more for it, but it doesn't mean you're right. It doesn't mean that the company is valued at $10,000 a share. It just means that you found an idiot to pay more than you, found a bigger idiot than you to pay more than you did. It doesn't mean you're a good investor. It means you're a horrible investor. You just got lucky and found some moron to pay more than you did. But what is tried and true is to value a business and know what that business is worth, and if the business is selling for significantly less than what the assets are worth, you're going to make money regardless of whether the company goes bankrupt or not. Now, it's possible sometimes the financials are fraudulent, sometimes the company is fraudulent, and sometimes you will lose 100%. And sometimes you've made a mistake and your math was wrong. But 90% of investors are attracted to the glamour stuff. 90% of investors, they want to buy when everything is at the highest, and they want to sell and panic when everything's at the lowest. Whereas the good investor does the opposite. They're selling when things are crazy high. They're buying when things are crazy low and pessimistic. So you have to train your mind to do the opposite of what human nature tells you to do. And the people operate on fear and greed. And there was a lot of money to be made recently with the bank crisis, but you could also have got burned too, because a stock can fall 70% in one day. If you're buying after that 70% drop, yeah, you might make a huge payday, but you also could lose your investment. So that's the risk you're taking by doing that. But if you knew for a fact that that bank or whatever was worth 5 times whatever the stock price was selling for, you could have made a fortune right there. Thank you for listening.